Most people think there's only one stock market. But here's the shocking truth. There are actually different types of markets operating behind the scenes. And if you don't know the difference, you could end up buying at the wrong time, selling too early, or completely misunderstanding what's happening with your investments. So in the next 3 minutes, you'll learn the 4 major market types every investor should know. And trust me, the last one is where fortunes are often made. Let's dive in. Imagine you're driving on a road. Sometimes traffic flows smoothly. Sometimes it's a total mess. And sometimes the road is completely empty. The stock market works the same way. 1. Bull market. Let's start with the most exciting one, the bull market. A bull market is when stock prices are rising consistently over time. Investors are optimistic. Companies are growing. And confidence is high. Think about the years following the 2008 financial crisis. Many major stocks multiplied in value as the market climbed higher and higher. During a bull market, it feels like everyone is making money. But here's the catch. Bull markets don't last forever, and that's where many beginners get caught off guard. 2. Bear market. Now imagine the opposite. Prices are falling. News headlines are negative. Investors are scared. Welcome to a bear market. A bear market typically happens when stock prices fall 20% or more from recent highs. One of the most famous examples happened in 2020 when global markets crashed due to uncertainty surrounding the pandemic. People panic. Many sell at a loss. But here's something surprising. Some of the greatest investment opportunities are born during bear markets. Why? Because quality companies often become available at discounted prices. 3. Sideways market. Now here's the market nobody talks about. The sideways market. Prices move up, then down, then up again. But overall, they go nowhere. It's like running on a treadmill. Lots of movement, very little progress. These periods can frustrate investors because nothing exciting seems to happen. But experienced traders often look for short-term opportunities while long-term investors stay patient. Not every market is booming or crashing. Sometimes it's just waiting. 4. Primary market versus secondary market. Here's a market type that surprises many beginners. When a company sells shares to the public for the first time through an IPO, that's called the primary market. This is where new shares are created and sold. For example, when a company goes public, investors buy shares directly from the issuing company. But once those shares start trading on exchanges, they move into the secondary market. That's where most of us buy and sell stocks every day. In simple terms, primary market equals new shares. Secondary market equals existing shares changing hands. And almost every investor spends most of their time in the secondary market. So let's recap. Bull market, prices rising. Bear market, prices falling. Sideways market, prices moving nowhere. Primary and secondary markets, where shares are first issued and then traded. Understanding these market types won't make you rich overnight, but it will help you make smarter decisions and avoid costly mistakes. And that's exactly what separates successful investors from everyone else. If you found this video valuable, hit the like button, subscribe to the channel, and turn on notifications because we're breaking down investing and wealth-building concepts in the simplest way possible. And here's a question for you. Which market do you think we're in right now? Let me know in the comments below. Thanks for watching, and I'll see you in the next video.